Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. As you can probably tell, I got a new camera. So if you're watching this on TV, which I check the analytics and 35% of you are, I should look far more handsome today than I did yesterday. All right. I hope everyone had a very Merry Christmas, Happy Holidays. I had a great time. I went out to Vegas and spent some time with the family, even won a poker tournament, which paid for the whole holidays. That was awesome. And now we're back at it. So we're coming up on the end of the year. Got some charts to share with you guys. And without further ado, let's go to the charts. All right. So here we have some that I pulled up. This is kind of more of a warning than anything else. Okay, so this is the S&P 500. We thought that we might have a little bounce here in the S&P around 38, which is what we're getting, and you can kind of see that from this trend line going back. I do not anticipate that it'll go above the 200-day moving average. I think we might get, they call it a Santa Claus rally towards the end of the year. That may be the case, but I fully expect this to kind of continue its downtrend. One of the reasons I do is because of one of the major holdings of the S&P 500. Let me go to a different screen share here. And this is just simply something that you can pull up on Investopedia. And you can see the top holdings of the S&P 500 and the sectors that they're in. So information technology, we've had a huge boom in that in the last few years, and it's made up a major weighting of the S&P 500 index here. There's 11 different sectors. Information technology is over 25% of it, 26.4 according to Investopedia. Then healthcare, consumer discretionary. So my base case argument is that I think that raw materials, commodities down here, probably energy as well, are going to start making up a bigger percentage of this. So we really don't need a whole lot of money to come out of technology and these other ones. Consumer discretionary is probably not going to do well during a recession. We don't need a whole lot of the money to come out of this and move into this to have a big move. If this goes from 2.5% to 5%, that's a doubling within the sector. But look at the weighting of information technology. And if we see what the top few companies are here in the S&P 500, Apple makes up 7%. So if Apple's not doing well, that's 7% of the S&P 500. Microsoft is over 5.5, Amazon's over 3, Tesla's 2, right? Look at Google. Down here we got Meta, makes up 1% of it. So if we go back to the charts, and keep that in mind when we look at here at the S&P 500. Now let's go and take a look at Apple, the biggest weighting. This is very concerning to me on this chart. If you look at what happened, there was all kinds of news over Apple on YouTube about a week ago. And they were like Jim Cramer, buy, 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 right? And I could see what they're seeing. We got a reversal bar right here. And we had that on the last week. I can understand they were right for about a day, okay? And going back, you can see the resistance here and why they were saying that. Well, it's broken below that. We now got to move this line down, this support line, and track it back. There is some real risk here of Apple going down, which is going to bring the S&P 500 down, right? Now let's take a look at another big holding of the S&P. 1% of it is made up here of Meta. Just look at what it's done since the beginning of the year, and we just have an absolute tanking. I mean, how much further is this going to go? I can pull it up here on the weekly chart, and you can really get an idea of what has happened to this company. Okay, this is 1% of the 500 companies that make up the S&P 500. This is a 1% weighting of that. Now let's take a look at Tesla. That's a 2% weighting. Oh man, I feel sorry for, and this is, we talked about this about a year ago at the beginning of the year. The answer, in my opinion, is not Meta. The answer is not Tesla, and the answer is not technology in this new cycle. I think the answer is commodities. Okay. Um, there's another warning that I've gotten a few questions on lithium, and here's a popular lithium ETF, LIT. We're seeing a breakdown in this as well. Um, if it fails this resistance line right here, which is around 55 bucks, you got some real downside here to, in the mid to high 40s. Okay, we're at 59 right now. This isn't looking too good. If it fails the 200 weekly, and take a look at what it's done over here on the daily chart. Okay, we've already failed the 200-day moving average, and there's really not a whole lot of support under this. And I have a feeling that this is not going to go well in the early part of 2023. Albemarle, this is the biggest lithium miner in the world, and they're starting to see a breakdown in the charts here. On the daily chart, it's crossed through every single moving average. There's not a whole lot of support underneath that for quite a ways. You got some real downside risk here of 10 or 15%, possibly even more. So I think that, getting out of these while you can might not be a bad idea. Okay, some other purchases that we're looking at. We've been talking about the TLT for a while. And we're coming up on a point now where I believe we may be entering a buy zone. Now, remember, I'm looking at this as an 18 to 24 month hold here. We got in down here at about 94, and we're kind of coming into a buy zone here. We ran the Fibonacci retracement, and we're just hitting in that right now. I would really like to see another bounce here. I would like to see it would like to see it go up, come back down and bounce and go back up. That would be ideal. I think I'm going to put in a limit order here for about $100, maybe $100.50, and see if it hits. But I think this is a decent purchase point here for the TLT if you have a time frame like I'm talking about. Remember, bonds have just absolutely gotten killed over the last year. The Fed is raising rates, which should continue to drive this down. I'm thinking that the bond market probably sniffed this out ahead of time. That's why we made our bet down here. I talked about that in a previous episode. When the Fed's mouthpiece, Nick Timiraos, comes out and kind of broadcasts what the Fed is going to do, that's kind of when we're hitting these bottoms. So possibly one here on TLT. We'll put a limit order in on that. We'll go over to gold now. Gold is looking a little overbought, and I would not be surprised at all to see gold correct. And as a matter of fact, I would actually enjoy seeing that. Maybe come back down and hit the 200-day moving average. Same goes for silver. Silver's pretty overbought, and see this trend line that we're going up. This does not look sustainable to me. This looks like we need kind of a healthy correction, something to come back down. I would love to see it come back down to about 20, and we could really kind of double down on some of the silver miners that we got, possibly even a physical position, although the premiums just seem to balance that out. It seems like you're paying about 27 or 28, kind of regardless of what the price has been over the last month or two. The premiums either catch up or drop down, just depending on the spot price. But I did get a deal for 25 bucks for some Buffalo rounds about a month ago, maybe 3 weeks ago. That was about the cheapest that I've had in the last long time, probably a year. So might get lucky with that. That's basically what I'm seeing here. Uranium looking pretty good. We got in our bet last week down here around 30 bucks. Remember, the stock halved in price because they did a 2-for-1 split. So you know, if it was $60, now it's 30, but you own twice as many shares. So I think they did that for the options market. I'm not sure. It's just a guess, but I believe that's why they did it. So anyhow, we'll be keeping an eye on TLT. That's probably the only purchase that we'll make this week. And I think that's about it. I hope you guys got something out of this. Please like and subscribe, and I will talk to you next time.